Hi, my name is Dr. Ewan McGahey. I'm a reader in the School of Law, King's College London, branch president of KCL-UCU, and I'd like to talk to you in a re-recording about USS pensions, a real town hall that we did on the crisis and how we're going to fix it. So I'd like to take you through a few slides on why we've got a crisis and another strike coming, the details of what's happened, including the valuation and the so-called deficit, which is really a surplus in the pension fund, and sort of generally what's gone wrong, but most importantly, how we can fix things, what we can do to ensure that we have better social security, hold the people responsible that have caused the crisis, and set up a better, more democratic governance structure for the pension fund. So the first thing to start with is the big picture of the right to social security and to retire. The Universal Declaration of Human Rights, Article 22, says everyone as a member of society has the right to social security, and that includes a standard of living adequate for old age. The way that we realise these human rights in national law in the UK is through a system of three pillars in a pension fund. The first pillar is the state pension, which gives you a sort of minimum floor through which nobody is meant to fall through. That comes from national insurance contributions and amounts to roughly more or less a flat rate per month. Now, that doesn't give you a sort of fair income that reflects your pre-retirement earnings. And so in the UK, we have a very large occupational pension fund sector, or a workplace pension fund sector. And that's what we're going to be focusing on today and what the university superannuation scheme is. The third pillar of pensions is private savings or investment, like mutual funds, especially if you've got a lot of money. But we're just going to be focusing on the workplace pension system at USS. And it's important to see, as many people know, that what happens when you save in a pension is your money goes through an investment chain to be invested in order to get returns so that you have a more comfortable retirement than if you just put the money under the mattress. So the investment chain typically is as follows. There's you or I, which save money from weekly deduction or monthly deductions in your salary. The money goes from you to USS, our pension fund, and USS delegates to lots of different fund managers in the city, like JP Morgan, Legal & General, perhaps BlackRock, in different arrangements of funds, which then go and invest in different asset classes. The most familiar one will be listed companies like Tesco plc, Barclays, maybe still fossil fuels like Shell, and that's just one asset class. For equities, then there could be corporate bonds, there could be government gilts, or there could be housing, real estate, commodities, you name it. But all of these investments are meant to make you a return in retirement. The problem in the UK is that retirement is precarious, particularly compared to other countries. So the UK replaces just on average around 30% of pre-retirement income if you're the average earner, about 50% if you're amongst the lowest income group, according to this chart from the OECD. So compared to rich countries, other rich countries, the UK is doing pretty badly, providing lower levels of pensions than our counterparts. And the reason that we get a lower percentage of pre-retirement income, what we call the replacement rate, is because pensions where employers guaranteed incomes for the rest of people's lives, what are known as defined benefit plans, have largely been cut or closed, particularly beginning in the 1980s. And the alternative to this is a lump sum style pension. That's what we call a defined contribution, where what you put in is what you get out plus the investment return. But the employer does not guarantee you an income for life, no matter how long you live. And that's pretty bad if you are, like most of us, quite unsure about when we might die. If you live longer than expected, the money can run out. But these systems of pensions, DC or defined contribution, are very good for city fund managers because what they do, like JP Morgan, Citigroup, HSBC and others, is they sell people annuity products when they retire so that you can get, like an insurance contract, to pay you out an annual sum for the rest of your life, of course for a lot more fees. Now, income guaranteed pensions, the defined benefit type, although they've been closing down, still do exist, and that's one of the main things that the university pension does. But in order to ensure that there's enough money in the pension to be paid out to future retirees, they have to be valued on a regular basis, roughly every 3 years, and that's where much of the crisis has begun. So what has happened at USS is that the trustee directors and managers of the fund have done valuations first in 2018 in a slump, and then in 2020 in a big stock market crash. So that's what this chart shows. The FTSE 100, of course, Financial Times Stock Exchange listing of all the biggest companies in the UK. This chart shows the index's movements from 2017 to 2021. And you can see in March 2018, there was a valuation in one of the slumps. That led the USS trustees and managers to predict, unsurprisingly, that there was a deficit. And then they did the same thing again, just as the worst stock market crash in modern history, or one of the worst stock market crashes in modern history, hit just after COVID-19 broke out and led to the lockdown. So the 30th of March 2020 was the valuation date, according to USS, for when the assets of the pension fund should be valued. So that led the USS to predict that there would be deficits of an order between 14.9 billion and 17.9 billion, again, to pay everybody's pensions out in the future. This isn't a current deficit, but it's a prediction of whether in 30 years, 40 years, there will be enough money to pay all the retirees. It said that there was £66.5 billion in the pension fund on the 30th of March 2020, but we know that the fund assets rose considerably, in fact by over £22.3 billion to £87.8 billion from March 2020 up to July 2021. So you might be wondering, well, how can it possibly be that there's still any kind of deficit? Isn't the problem resolved? Well, according to the USS directors and trustees, the date actually doesn't matter because of what they call their technical provisions assumptions. What these assumptions do in the valuation methodology is they calculate, with things like how long are people going to live, the mortality rates, what the expected rate of growth in the assets of the pension fund will be. And their technical provisions asserted that there would be a 0.0% growth rate in the assets over the next 30 years above CPI inflation. So 0% growth above the consumer price index basket of inflation of how much the bread and the milk and so on costs. Almost zero growth in real terms. But we know that since 2020, March 30th, there has been actually over 28% growth above CPI inflation in USS's assets, and that's just over 15 months, let alone 30 years. And of course, 28% is a much higher number, especially in 15 months, than 0% over 30 years. In other words, the assumptions are absolutely incredible. This is the technical provisions consultation document from August 2020. It's just a screenshot of the page, buried in the detail on page 28. And what it shows here, just near the arrows, is assets of 66.5 billion under what we call the tending to strong covenant here. There's the deficit prediction of 17.9 billion. This is assuming that the contributions and the accrual rates, the payment rates, the entitlement rates of USS stay the same. And here is the assumption that there would be zero growth for the next 30 years above CPI inflation. Now, this all led USS to say that what had to happen is that the university employers needed to put up contributions to meet this so-called deficit, or there would have to be cuts. USS said to the university employers, Universities UK, if you don't cut, we will raise contributions unilaterally from around 30-34% of people's existing salaries up to 40-50% and above. And it gave a list of scenarios for university employers to follow. Instead of stopping what was happening. Universities UK, instead of trying to change the USS constitution or remove the board, it decided that it would be easier to back cuts to the pension and not back staff or support staff, but cut their pension pay, even despite COVID and the crisis and the workload that everybody's been going through. So currently what the USS/UUK plan is to reduce the income guaranteed threshold from £60,000 to £40,000. And so that means that if you earn over £40,000, instead of getting a guaranteed income up to the 60,000 threshold, you get a DC lump sum. And that means effectively that if you live longer than you expect, it might run out. Perversely, you've got a financial incentive to die quickly. It also says in the USS/UUK plan that the accrual rates will be cut from 1/75th of salary to 1/85th. So what that means is that if you work, let's say, for 40 years at university, you get, instead of 40/75ths of your salary, you get 40/85ths, which is a much smaller amount. And all of this comes to around 25% being cut from your pension pay. If you're younger, the pension cut will be much more, and you can find out what exactly it means for you at the UCU USS modeler in this link. And all of this is happening, cuts are being proposed while USS is squandering your pension money on an astronomical scale. So if we go back in the annual reports to 2008, we can see that total operating costs of the USS pension was about £40 million a year. But that has risen to £160 million every year that USS is spending from your money to administer your pension while giving you ever less and predicting very high or even massive deficits. They're spending £120 million extra every year now. And we can see what this means in terms of the number of asset managers that they've hired, all the lovely new offices that they bought near the Bank of England on 60 Threadneedle Street. Who is running this, by the way? Well, dominating the USS board are ex-City fund managers. These are people appointed by the board itself of USS Limited. They include people that used to be at JP Morgan, at Citigroup, at HSBC. The chair of the board, Dame Kate Barker, used to work in the coal industry. And by the way, another thing that has racked up an incredible amount of money from your pension is that USS has refused to divest from fossil fuels, even though members in an ethical investment survey in November 2020 said by a big majority that they want to. But it's not just an ethical issue now. Coal and oil and gas are the worst performing asset classes every year since 2017. And so that's another way in which USS is using your money unwisely. So it's not just about the CEO pay, which gets a lot of headlines. That Bill Galvin, he's paid about £750,000 every year, roughly triple what the CEO was paying themselves about 10 or 12 years ago. It's actually much bigger than just the CEO pay. It's this enormous ecosystem of bureaucracy spending £120 million of your money every year to give you less and less and say that there's deficits. So what can we do to fix all of this? Well, here is a list of 6 suggestions. The first thing that we can do is we can inform ourselves, our students and each other about what USS is doing. And we can reject the attempts to make pensions sound complex when really it's smoke and mirrors being puffed out by people who have an interest in making pensions sound complex. In fact, there's a very simple narrative going on, which is that you're getting less and they're getting more, and they are not acting in your best financial interests. The second thing is that we have to reject the notion or the narrative that we must follow the valuation from March 2020. This isn't required by law in the Pensions Act 2004. The relevant provision is section 226. It's falsely suggested that regulation mandates that there have to be cuts to the pension, or that there has to be a deficit reported, or that the methodology and the assumptions, which are absolutely incredible, cannot be changed. This is simply not true. The third thing is that we have to reject the falsehood outright that there is in fact a deficit, either now, which there's not, or in the future, which there is not going to be either. In fact, there is a really big surplus in the university pension, and so we should be talking about how it can be enhanced and how contribution levels can be brought back down again, not that the pension should be cut. The fourth thing that we can do is back legal proceedings. So KCL-UCU, along with a lot of other branches around the country, Bristol, Oxford, Imperial, Cardiff, Edinburgh, 1,500 individual donors as well from all over the UK have helped crowdfund £50,000 to be raised to instruct barristers to bring legal proceedings against the fund managers of USS, the trustee directors and managers, for breach of their duties to act in your interest, because fundamentally that's not what they're doing at the moment. The fifth thing that we can do is we can just say no to what is happening, the 25% pension pay cuts, and we can organise to take collective action, including a strike, if the employers and USS fail to reverse this senseless attack on everybody's future and on social security. And the sixth thing that we can do is we can support democratic governance reform. An excellent report by Professor Sir Roy Good in 1993 outlined why, if you have any element of defined contribution in the pension system, then it should be at least 2/3 of the people who are beneficiaries of the pension fund electing the board of the pension fund, because the beneficiaries in a defined contribution scheme bear the risk. And so, at USS, where it's a hybrid of both, then we should be at least looking at majority elected pension trustees in order to ensure that the people who are managing pension money are accountable to the people whose money they are in control of. So please get in touch if you want to ask any more questions. Keep yourself informed, and let's make sure that we have a better future for social security and that we can do everything possible to fix it.